Welcome to the Deep Dive.
Great to be here.
Today we're cutting through the noise, getting straight into the latest from Zoom Communications. Their second fiscal quarter 26 results just dropped.
Yep, the period ending July 31st.
Exactly. We're going to unpack what these numbers tell us about, where they stand now, their strategy shifts, and what they're forecasting for the rest of the year.
It'll be interesting.
All right, let's jump right in. So Zoom announced these Q2 FY26 results. The top line. Total revenue hit about $1.217 billion. That's up 4.7% year over year.
Okay, 4.7%.
Yeah, but here's the kicker, right? That 4.7% growth, it's actually their highest year over year revenue growth in, get this, 11 quarters.
Wow, 11 quarters.
Yeah.
Well, that's quite a turnaround from the deceleration we saw after the big pandemic boom.
Definitely. It feels like a statement. It suggests maybe they're finding a new gear.
It really does. That acceleration, especially hitting an 11-quarter high, points to a business finding its footing again, maybe validating some of their recent strategic moves.
So where's this growth actually coming from? If we break it down a bit, the enterprise segment really seems to be the engine here.
Right.
It brought in $730.7 million, growing a solid 7.0% year over year.
Mm-hmm.
The online segment, well, that was flatter, grew 1.4%, hitting $486.6 million.
And that split is really telling, isn't it? Seeing enterprise pull ahead so clearly compared to online.
Yeah. What do you make of that?
Well, it strongly suggests that strategic pivot towards larger organizations, deeper relationships there is really paying off. It's less about sheer volume now, more about that high-value enterprise market.
So a shift from, pandemic necessity to core business tool.
Exactly. It hints at a business model finding maybe a more sustainable long-term equilibrium. Maturing, really.
Okay. Makes sense. They're focusing on those bigger fish.
Yep.
But revenue growth is one thing. What about the bottom line? Profitability.
Always the crucial question.
Mm-hmm.
And yeah, the profitability numbers are pretty compelling too. Well, their GAAP operating margin came in at 26.4%. That's a big jump, up 90 percentage points from last year.
9 points, okay.
And the non-GAAP number, which, strips out things like stock-based comp and acquisition costs to give a cleaner view of core operations.
Right, the operational picture.
That was an impressive 41.3%. Really strong.
Wow, okay. 41% non-GAAP op margin is definitely robust. And earnings per share, how did that track?
So GAAP EPS was $1.16. That's up a huge 65.7% year over year.
65%.
Yeah. And the non-GAAP EPS, again, focusing on operations, was $1.53. Still a solid 10.0% increase.
So strong growth there, too.
Absolutely. And taken together, that substantial margin expansion, both GAAP and non-GAAP, alongside the EPS growth, it really highlights their focus on efficiency. Cost optimization.
Disciplined financial management, sounds like.
That's exactly it. It shows they're not just growing, but growing profitably, which is key for, sustainable performance.
Okay, profitability looks solid. That discipline you mentioned often shows up in cash flow, too. How's Zoom looking on that front?
Oh, definitely. Their cash flow generation was quite strong this quarter.
Give us the numbers.
Net cash from operating activities was $515.9 million. That's up 15% year over year.
15%, nice.
But the really eye-popping number is the free cash flow, or FCF.
Which is, just to remind everyone, the cash left after they pay for operations and capital expenditures.
Precisely. Their FCF grew a whopping 39% year over year.
39%. Wow.
Yeah, hitting $508.0 million. And that translates to an FCF margin of 41.7%, which is up 10 points compared to last year.
Okay, a 39% jump in free cash flow, 10-point margin expansion. What's driving that kind of efficiency gain, do you think?
It's likely a mix, right? Those improved operating margins we talked about are a big piece, but also probably some very disciplined management of their capital spending.
And what does having that kind of free cash plus their existing reserves actually mean for them? They ended the quarter with a big pile of cash, right?
A very big pile. Around $7.8 billion in cash, cash equivalents, and marketable securities.
That's a serious war chest.
It gives them tremendous flexibility. They can plow more into R&D, especially AI, which seems to be a huge focus, or make strategic acquisitions, or return more value to shareholders.
And speaking of returning value, they were active with share buybacks again this quarter.
They were. Repurchased about 6.0 million shares in Q2.
Okay.
That brings the total under their current authorization up to 27.4 million shares bought back.
So actively reducing the share count?
Exactly. It underscores that commitment to shareholder value, helps boost that EPS figure we discussed, and it signals management's confidence, that the stock is potentially undervalued.
Right. So we've got strong financials, good profitability, great cash flow. But let's get back to the drivers. What's actually making this happen on the ground?
Well, a lot points back to that successful enterprise focus we mentioned.
The customer metrics back that up.
They do. They saw an 8.7% year-over-year increase in customers who contribute more than $100,000 in trailing 12-month revenue.
Okay, the big spenders.
Yep, they now have 4,274 of those customers. And their net dollar expansion rate for enterprise customers, basically, how much existing clients increase their spending, held steady at 98%.
98%. So almost flat, meaning good retention, but maybe not huge upsell across the board yet.
It indicates strong retention, certainly, holding on to those valuable customers.
Yeah.
And on the online side, their average monthly churn stayed flat year over year at 2.9%. Stability there, too.
Stability seems to be a theme here after maybe a more volatile period post-pandemic.
I think so. Stabilization and a clear focus on that higher value segment.
Okay, and what about the elephant in the room, AI? Eric Yuan, the CEO, was quoted saying, AI is transforming the way we work together and Zoom is at the forefront. Is that just talk, or is it translating into results?
It definitely seems to be more than just talk. They highlighted that AI companion monthly active users grew over 4 times year over year.
4 times. That's huge user growth.
Millions are apparently using it for meeting prep, summaries, all that kind of stuff.
Yeah.
But maybe more importantly,
Yeah.
they actually won a deal with a Fortune 200 tech company, specifically for their custom AI companion. That's a paid add-on.
Ah, so they're monetizing it. It's not just a free feature to keep up.
Exactly. That's a key proof point. It shows high-value clients are willing to pay for specialized AI capabilities built on Zoom's platform.
So when they talk about building this AI-first open work platform, what else falls under that umbrella? It's not just the meeting assistant, right?
No, it's much broader. They mentioned their virtual agent 2.0, for instance. It's moving towards what they call agentic AI,
Agentic AI, meaning
it can act more autonomously, make decisions, take actions, not just respond. Think customer service bots that can actually resolve complex issues or initiate follow-ups without constant human hand-holding.
Okay, that sounds like a potentially significant step up.
It could be. And then you look at their departmental solutions. Zoom Contact Center, ZCC, saw a 94% increase in customers spending over $100K annually.
94% increase in those big ZCC customers. Wow.
And WorkVivo, their employee experience platform, was up 142% in similar high-value customers.
Okay, so contact center employee experience. They're really pushing beyond just video meetings.
Definitely. These aren't just side projects. They're becoming core parts of the offering, driving significant deals, saving clients money, and sometimes even displacing competitors. It's about embedding Zoom deeper into the entire workflow of an enterprise.
It really does sound like they're trying to evolve from just the meeting app to, well, the whole digital workspace infused with AI.
That seems to be the vision.
So with all this momentum, this strategy playing out, what does it mean looking ahead? How are they feeling about the next quarter and the rest of the fiscal year?
Well, their guidance certainly reflects confidence. They provided an updated outlook, and significantly, they've raised their full-year forecast.
Raised it. Okay, that's usually a strong signal. What are the specifics? Let's start with Q3.
For Q3 fiscal 26, they're projecting total revenue between $1.210 billion and $1.215 billion.
Correct.
And non-GAAP diluted EPS between $1.42 and then $1.44.
Got it. And the full year raise, what do those updated numbers look like?
For the full fiscal year 26, they now expect total revenue between $4.825 billion and $4.835 billion.
All right, a bump up there.
And non-GAAP diluted EPS expected between $5.81 and $5.84. Also raised.
And did they raise the cash flow guidance too, given how strong Q2 was?
They did.
Yeah.
Full-year free cash flow guidance is now $1.74 billion to $1.78 billion. Also raised.
Okay, so raising guidance across revenue, EPS, and free cash flow for the full year, that feels pretty bullish.
It's a strong vote of confidence from management, absolutely.
Yeah.
It suggests they see these positive trends from Q2 continuing.
Sustain enterprise growth, the AI stuff starting to pay off.
Exactly. Continued traction in enterprise. The platform innovations, including AI, really contributing. It implies they feel good about market demand and their own operational execution.
Anything else notable about that guidance?
Well, one small detail, but potentially interesting for investors, their guidance figures for EPS and share count don't yet include any potential impact from the remaining $724.7 million. they're still authorized to use for share repurchases.
Ah, so if they keep buying back stock aggressively.
There could be some additional upside to that EPS guidance down the line. It adds another layer of potential positive surprise if they execute on that buyback.
Okay, so wrapping this up then, it looks like Zoom delivered a pretty solid Q2, strong enterprise growth, AI playing a bigger role, really healthy cash flow.
And all that leading to them raising the outlook for the year.
It really feels like a company that's, successfully navigating that post-pandemic transition.
Yeah, the numbers seem to reflect a business that's adapting, evolving, proving it's more than just a one-hit wonder from that era. They're showing they can innovate and stay profitable in what's still a very competitive space.
This deep dive really highlights that strategic push, doesn't it, towards AI, towards being a broader platform, not just meetings.
Yeah, and maybe the key takeaway for you listening is seeing how a company can use that combination, technological innovation and disciplined financial management, to navigate big market shifts. It's about building for sustained performance.
So it leaves us with a question to think about. As Zoom keeps pushing deeper with AI and expanding this platform strategy, how might that shake up the whole digital collaboration landscape? What new things might emerge, maybe things that could disrupt some of the other players out there?
Something to chew on.
Definitely. Something to think about as you go about your day.
That's all for this Dope Dive.
Thanks for tuning in.
Until next time, stay curious.